Ladies and gentlemen, this call is not for media representatives or Bank of America investment bankers or commercial bankers, including corporate and commercial FX. All such individuals are instructed to disconnect now. A replay will be available for Bank of America investment bankers and commercial bankers, including corporate and commercial FX. The replay is not available to the media. Good day and welcome to the Bajaj Finance Limited Q4 FY24 earnings conference call. This call will be recorded and the recording will be made public by the company pursuant to its regulatory obligations. Certain personal information such as your name and organization may be asked during the call. If you do not wish for it to be disclosed, please immediately discontinue this call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. I now hand the conference over to Mr. Anuj Singla. Thank you and over to you, sir.
Thank you, Nirav. Good evening, everyone. This is Anuj Singla from Bank of America Securities. Thank you very much for joining us for the Bajaj Finance earnings call to discuss Q4 and full year FY24 earnings. To discuss the earnings, I'm pleased to welcome Mr. Rajiv Jain, Managing Director, Mr. Sandeep Jain, CFO, and other senior members of the management team. Thank you very much for giving us the opportunity to host you. I now invite Rajiv for his opening remarks, post which we will open the floor for Q&A. With that, over to you, Rajiv.
I have with me Sandeep Jain, who's the CFO, Anup Saha, who's our DMD, Atul Jain, who's MD, BHFL, and Manish Jain, MD, BFSL, and a set of my colleagues, Nilesh Sharda, who's Chief Compliance Officer, Fakri, Chief Risk Officer, etc. I'll take you through the investor deck, which has been uploaded on BSE, NSE, and the investor section of our website. Let me jump right on to panel 4. I hope to take 20-25 odd minutes to take you through important sections, and then I'll hand it over for question and answers. In terms of Q4, I'm on panel 4. Good quarter on AUM, customer acquisition, portfolio metrics, and operating efficiencies. Dampener of the quarter were elevated loan losses in rural B2C and continued impact of regulatory restrictions. Overall, in the quarter, we delivered 19,647 crores of AUM growth, booked 7.9 million loans, just a tad below 7.9 million loans, and added 3.23 million new customers in Q4. The app, if you're using it, or I would strongly recommend you download and you start to use it, has gone through a major upgrade in Q4, significantly expanding our products, services, and host of new features on the app and web platform. Bajaj Finance app now overall has 52.5 million customers, net users at this point in time. In terms of financials, we ended the year with AUM of 3,30,600 crores, a growth of 34%. OPEX to total income came in at 34%. That is really where it's been for the last 3 quarters now. PAT came in at 3,825, a growth of 21%. ROE, as a result of capital raise, came in at 20.5%. Net NPA came in at 0.37%. More. I'm on panel 5. Which is the full year summary. Overall, I would say a good year across all financial and portfolio metrics for the company. Delivered AUM growth of a record 83,236 crores. We disbursed overall 36.2 million loans and added a record 14.5 million new customers in FY24. Clearly, regulatory action on two of our products was a setback for the year. We remain committed to compliance in form and spirit as a company. And I'll cover as to how we've acted on the embargo on the KFS just in a short while. We're rapidly implementing our key LRS megatrends that we outlined in Q3 to investors. Account aggregator now, we have 22% of India's account aggregator on a run rate basis. We have 8.1 million customers who have given us consents. ONDC, which is on track to go live by June 24. Social commerce as a platform by July 24. Rewards as a platform by June 24. And O2O2O to make life significantly easier for consumers by June 24. It would All these actions, as implemented, should significantly strengthen our competitive moat and also improve our cost-to-income ratios. AUM full year I've talked about, 330,000. OpEx to NIM on a full year basis also came in at 34% because last 3 quarters that's really where the number has been. PAT has grown by a healthy 26% to 14,451 crores. ROE on a full year basis has come in at 22.1%, and net NPA ending March is at 0.37%. So that's the full year. I'm on panel 6 very quickly. Some of the points I just cover, which is point number 4. On panel 6, new loans booked were lower by approximately 0.8 million, as we articulated even in an early press release, on account of restrictions placed by RBI on the company on account of e-com and Insta EMI card. Total cross-sell franchise crossed a milestone of 50 million customers and stood at 50.75 million customers. The company added 53 new locations and added 7,700 distribution points. We are now physically present in 4,145 locations and serve over 198,000 active distribution points as of 31st March. In terms of liquidity buffer is strong at 15,700 crores. Cost of funds continue to inch up, albeit slowly now. It grew by 10 basis points on a quarter-on-quarter basis, on a sequential quarter basis, was at 7.86% as of March 30 in the quarter gone by. Deposits book also grew in line with the assets growth, grew by 35% and stood at 60,151 crores. Net deposit accretion was 2,143 crores. Deposits on a consolidated balance sheet now contribute to 21% of overall borrowings. In terms of operating efficiencies, net interest income grew 28%. NIM compression in Q4 over Q3 on a sequential basis was 21 basis points, primarily contributed by AUM composition changes. As we move more and more of our assets, or just repivot our assets slowly to rightful balance between secured and unsecured, there is some level of compression that's slowly evident in net interest income. OpEx to total income came in at 34%. Companies rapidly deploying various GenAI initiatives across operations, service, and contact centers to enhance operating efficiencies. The bigger benefits will not be visible in 24-25 or FY25, but in FY26, the exit rates of FY25 should be much stronger as we sharpen the pencil in terms of inducting GenAI across our processes as a company. Employee headcount, as a result of optimization of our operating cost model, after 8 odd quarters went down. It stood at 53,782. The employee headcount reduced by 499 people in Q4. Attrition, on a full year basis, we came in at 14.9% versus last year of 18.7%. So continue to see improvement in overall attrition rates for the company. Credit cost, overall loan losses and provisions were 1,310 crores. The rural B2C business continued to trouble us even in Q4. AUM growth, and as a result, as I've always said, we are a risk-first company. Rural B2C growth actually came down from 25% on an AUM growth basis to 6% in March 24. So clearly, we still don't have a full handle on rural B2C, and as a result, the growth has been slowed down until such time we can tame risk in the business. Having said that, I must just qualify that it's 5-6% of the balance sheet, 18,339. Yeah, 6% of the balance sheet. So it's a contained risk, and I would say it does not impact the company in any manner on an overall basis. Loan loss to average AUF came in at 1.86% in Q4. The overall macro overlay came in at 300 crores. During the quarter, company utilized 127 crores towards strengthening of ECL model, which is an annual exercise, and released 163 crores towards loan losses and provisions. So the number was close to 590 crores, which has come down to 300 crores. GNPA and NPA came in at 85 basis points. It's the lowest that we've seen in the history of the company, and net NPA came in at 37 basis points. I think even in the industry, it's amongst the lowest GNPA ratios definitely, and NPA as well. Risk metrics across portfolios were stable, except the rural B2C business, as I said, which continued to trouble us. We continue to remain watchful on risk actions in the rural B2C business. Otherwise, all businesses are, from a management assurance standpoint at this point in time, being marked as green. I'm on panel 8. Profitability, consolidated pre-provision profit grew 25, PAT grew 21, annualized ROA came in at 4.84, ROE came in at 20.48, capital adequacy came in at 22.52, and Tier 1 capital was 21.51. 3-4 additional updates I thought I'll provide. I'm on point number 26, panel 8, that the board of directors of BHFL, which is a wholly owned subsidiary of BFL, at its meeting held yesterday, evaluated various options for meeting the mandatory listing conditions pursuant to BHFL classification as a upper layer company, and including a potential IPO. In this regard, board of BHFL has constituted a committee to undertake various actions and steps. That's really the update that we're going to provide at this point in time, and as and when the committee deems appropriate, we'll provide timely updates to the investors. In the quarter gone by, company, to diversify its borrowing profile, raised $725 million in external commercial borrowings, which was equivalent to 6,016 crores, all in 3-year monies. So now 2% of the overall borrowing profile is in ECB. At the peak of it, we used to have 4% of our borrowing in ECB. So based on market conditions, we expect to take it to 4% in the current year itself. Last point is point number 29 and 30 I want to cover. On panel 9, that the company has made required changes in response to the regulatory restrictions imposed by RBI on the company on sanction and disbursal of loans under Ecom and Insta EMI card. The company has formally requested RBI for a review and removal of these restrictions. To ensure compliance in form and spirit, the company, in addition to the 2 lending products which are under embargo, has implemented KFS now for all lending products effective 31st March. So any client who takes a loan from the company across retail and SME effective April 1 gets to receive a comprehensive KFS, and it's in 20 vernacular languages. So that's really the update on BFL standalone consolidated. BHFL had a good quarter. AUM was up 32%. Home loans grew 24, loan against property 23, lease rental discounting 57, and developer finance 69. Portfolio composition remains steady. BFL is fully meeting its PBC criteria of 60%. The number you see is 58% here, but based on PBC criteria, it's at 61%. Is what the PBC criteria. The hurdle rate is 60%. The company is at 61%. Overall approvals grew 19% to 19,500 crore. Disbursements grew 26% to 11,400 crore, and the company is now present in 174 locations. Liquidity was steady at 2,000 crores. Borrowing mix remained largely steady, with bank borrowings contributing to 51%. In terms of operating efficiencies, net interest income grew 11%. Total income grew 14%. OPEX to total income came in at 27%. Employee headcount stood at 2,400. The credit costs were virtually negligible, came in at 35 crores. And BHFL still holds a macro and management overlay of over 94 crores. GNPA and NPA are amongst the industry best at 27 basis points and 10 basis points. In terms of profitability, PAT grew by 26% to 381 crores, and annualized ROA came in at 2% and ROE of 12.65% on a quarter basis, on a full year basis at 15%. BHFL raised 2,000 crores through rights issue from BFL on 3rd of April 2024. It's sufficiently capitalized for 25-26 for 18 months of growth or so. So that aspect has been taken care of to ensure that whatever the committee of the board constituted committee decides in terms of its options, they are well capitalized. Bajaj Financial Securities ended the quarter with a 26 crore profit against a 3 crore profit a year ago. Profit after tax came in at 22 crores against a profit of 3 crores. Again, added 43,000 customers. The company on a full year basis delivered a pre-tax profit of 72 crores, giving us latitude to start to invest in the business to grow the business as we move from here. Next few panels are full year panels. I'm not going to spend time on that. What I wanted to do is to give you a management assessment for FY25 because questions get asked and we'll end up responding. I thought it may just be more prudent for us to systematically give you a management assessment for FY25. Also, importantly, we've been through 2 low years and 2 high years. If I take the last 4 years since COVID, and we're getting into a normal year, the way we see it as management. So I thought it's important we provide you a reasonable update or assessment from FY25 standpoint. I'm on panel 17 for the reference of people who are listening in. As you're aware, we have a well-established long-term guidance across AUM, profit, GNPA, NNPA, ROA, and ROE. We expect FY25, the way we see it at this point in time, to be a year of normalization to pre-COVID metrics. Adjusted for, of course, certain regulatory changes pertaining to NPA classification. So, and those NPA classifications have had an impact of 12 to 14 basis points. So it's a marginal change, but that's change. When your credit costs are to the extent of 1.7% and they go up to 1.82, that's a change, which is a 8-9% change that has happened as a result of harmonization of NPA classification between banks and non-banks, which RBI conducted between 21 and 22. When I look back over the last 4 years, what principally I come to conclusion is that the first 2 years of COVID were a low phase, and the last 2 years of COVID have been a high phase. From that perspective, we thought we'll just provide you a management assessment. This will all, of course, be subject to stable macroeconomic and regulatory environment. This assessment, I must just qualify, is for FY25 only, and we remain committed to achieving long-term guidance metrics for the medium term as a company, for which we are sufficiently capitalized, have full breadth of products, have large franchise, and a very strong moat in terms of business model. These are 7-8 areas that in general that you guys have, that the investors have questions on. I thought I'll just, clarify them in terms of our management assessment of FY25 is that we'll continue to originate 12 to 14 million customers in FY25. We added 14.5 million customers in FY24. In terms of AUM, we foresee a 26 to 28% balance sheet growth, principally supported by newly launched secured businesses such as loan against property, which will went live in Jan 23, new car financing which went live in July 23, and tractor finance which went live in January 24. Net interest margin has been moderating because of rising cost of funds and gradual shift in AUM composition towards secured assets. We expect cost to peak in our assessment at this point in time by July, August, and AUM composition repivot towards secured assets to stabilize by September 24. Accordingly, we foresee a 30 to 40 basis points moderation in NIM over the next 2 quarters from our current levels and then stabilize from there. Of course, global interest rates, local interest rates will still have a role to play both ways, if upwards or downwards. But this is assuming that by second half, sometime in second half of the year, we've peaked in terms of interest rates. That's really what the assumption is. In terms of OPEX to NIM, we expect improvement of 20 to 40 basis points from current levels, and as we continue to focus, we move from accelerated frame to a more consolidation stage. There could be a little bit of opportunity in OPEX to total income, even from these levels. In terms of credit costs, as I said, pre-COVID we used to be at 75 to 185 basis points. We expect to remain within that corridor. Last year was 182 basis points, or the year gone by is 182 basis points. We expect to remain within the corridor of 175 to 185 basis points. Return on assets, our long-term guidance has been between 4.6 to 4.8%. We expect to remain within the long-term guidance of 4.6 to 4.8%. ROE in FY25 may marginally go down as a result of capital that we've raised. But as you can see, ROE is holding steady, but mainly because of excess capital that we'll be sitting on, that we may see some level of little bit of drag on ROE in FY25. GNP and NPA expect to remain range bound and lower than our long-term guidance. Long-term guidance has been 1.2 to 1.4. We ended the year at 85 basis points and 37 basis points. We expect to remain between 85 to 95 between 85 to 100 basis points of GNP and NPA, depending on the quarter. On a full year basis, we expect this to be well within the current range. In terms of profitability, remain cautiously optimistic about FY25, with profit growth to be a little more rear-ended due to moderation in NIM in the first half of FY25. I think that I thought I'll just try and answer most of the questions that people have in a clear manner, so that we can. So that's really one of the last panels. Very quickly, we can just go to asset mix. That's panel number. The cross-sell franchise continued to grow well. So I'm mindful of time. In terms of asset mix, that's on panel 55 on a year-on-year basis. There is a 2.2% reduction in unsecured to secured mix. Urban B2C, as you can see, has gone down by 80 basis points, and rural B2C, as a result of the actions that we've taken, has gone down by 140 basis points, leading to 220 basis points reduction in unsecured. One is not by design. The second is by design, which is rural B2C, which I've talked about for the last 2-3 quarters. From this time onwards, we also started to separate. Rural B2C used to have gold loan sitting there. We've started to separate gold loan as well. Gold loan is now 1.4% balance sheet. Ending last year, we've also separated from SME lending the car loans balance sheet. It is now 2.1% of the balance sheet. So greater granularity in the balance sheet continues to emerge as we grow larger and larger in size. So two-wheeler, three-wheeler grew year-on-year by 80 basis points in terms of mix. Urban sales finance flat. Urban B2C down 80 basis points. Rural sales finance flat. Rural B2C down as a result of the actions. Gold loan moved up. SME lending 40 basis points down. Commercial lending moved 30 basis points, so on and so forth. That's really where the overall asset mix has been, but I would say marked by greater granularity as we continue to execute on our long-range strategy to be present in all retail and MSME categories that clients would want us to be. Just on as a last point on GNP and NPA, which is panel, and with that I'll hand over for Q&A. This is panel 58, range bound, plus minuses, not much movement here. As you can see, aggregate is where it is. Reasons for up and down are also different. If you have questions, you can raise them. We'll try and answer it. As to why is 40 basis points 31st March 23 is at 57, because the balance sheet in the preceding, in 31st March quarter, the urban sales finance balance sheet grew, whereas urban sales finance balance sheet in quarter 4 went down because of the embargo. So it's a numerator denominator point on urban sales finance and rural sales finance, and so on and so forth. That really brings me, in terms of portfolio quality, we remain on panel 62. From a management assurance standpoint, we remain pretty comfortable. As I said, everything eventually will go back to pre-COVID, adjusted for regulatory actions that happened in terms of GNP and NPA. Otherwise, we remain well ahead or still significantly better than where we were pre-COVID. I think that brings me to the end of points that I want to cover. Happy to take Q&A between me and the management team.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask the question. The first question is from the line of Shubhranshu Mishra from Phillip Capital. Please go ahead.
Hi, Rajiv. Thanks for the opportunity. I've got 2 or 3 questions. The first one is, do we have any plans to list in the international market, either through ADR or GDR? Second is with respect to fledgling businesses, which is one is gold loan, second is broken. When do we see 1,000 crore bottom line for each of the businesses? What's the timeline, if you can commit to that? Third is that the B2C business, when we include urban plus rural, that in my sense should constitute a larger amount of the profit pool, closer to 35-40%, basis which we cross-subsidize other products or other businesses. Now, given the fact that we have been getting the credit costs from these businesses, are we facing issues in cross-subsidizing the other businesses? Thanks. These are my 3 questions. Thanks.
So ADR, GDR, it's a new point, so I had not thought about it, but it's a good input. We'll evaluate and update you guys based on our assessment. We do know broadly that some of the leading firms in India are listed there. So thank you for the input. In terms of profit horizon, clearly we build businesses a long-term view. We expect microfinance. So in terms of size, if you start to think about it, and that's why we detail gold loan this time, we are now from 180 branches to 650 branches. Business is growing extremely well. You should continue to see progress there. We are very clear it is anywhere between 18 to 24 months by the time business becomes break-even, because we're doing business at scale, and 36 to 48 before it starts to meet hurdle rate, and anywhere between 40 to 60 before it starts to be a meaningful contributor to profitability. These are the 3 dimensions that go into our planning process. So clearly, as you can see, as we've been updating the street, that we've launched a whole host of businesses in the last 18 months. Microfinance, tractor, new car financing, lab, we're just launching commercial vehicle. So clearly, it's a we launched open architecture 2-wheeler 2 years ago. That should make money in the current year. So clearly 2 years to break even, and businesses are built with a 5 to 6 year view. But do we remain very focused on giving time, attention as you become larger to young businesses? The answer is yes. So that's the second point. In terms of your third point, you're principally saying that are they subsidizing? We run verticalized P&Ls for each one of our line of businesses internally. No business gets any subsidy. They all get capital at the same rate. It's a very established, disciplined process and methodology, and there is no cross-subsidization. Every business must meet, any business that we do, it can take 3 years, but must meet a hurdle rate of 14 to 15% ROE for us to even launch the business. And there is no concept of cross-subsidization in the firm, because we think that creates mediocrity in the way we run and conduct businesses.
My question still remains unanswered. What's the commitment in 1,000 crore bottom line for gold business and broking business?
Sorry?
Gold and broking business.
What will be the?
When do we hit 1,000 crore profit in each of these businesses, gold and broking?
So, so gold loan, look, at this point in time is growing well. You're aware it's a cyclical business because it's a commodity. So clearly growing very rapidly at this point in time. Okay? If the current run rate was to continue, in 3 years' time, it could be 1,000 crore profitability. But again, as I said, we're building this with a long-term view. The model and the template is well set. So now that's one. Coming to BFSL, had a pre-tax profit pool of 72 crores last year, should grow significantly, I would say, given their current run rate at this point in time, should get to 3-digit growth in the current year itself, and should compound, I would say 35-40% for the near term. Now, and then when I say, then you're talking 1,000 crores, that's a long way off for Manish Jain to deliver in BFSL. But again, I repeat, we are building business with a long-term view. We are quite excited about the business. Do we challenge all our businesses to hit a milestone of 1,000 crore profitability? The answer is yes. But are we patient enough to know that businesses take time to build? The answer is yes. So gold loan 3 to 4 years, longer for BFSL.
Thanks.
Thank you. A request to all the participants, kindly use handsets while asking a question. The next question is from the line of Viral Shah from IIFL Securities. Please go ahead.
Yeah, hi Rajiv. Thank you for giving me an opportunity. So I had 2 questions. One is basically, so first of all, how is the management transition happening with Anup now being elevated, and basically how internally it is playing out? Is it as per your expectations, and what are the changed roles and responsibilities now you are varying? That is point number 1. The second question that I had was also to do with now, again, we have now numerous instances of RBI placing business restrictions on different entities across the shades of different regulated entities. So wanted to get a sense of at least the common theme we have seen is that on issues that have been more recurrent issue between those regulated entities and RBI, those are the points basis which if they are left unaddressed, that is where RBI is stepping in with this kind of restriction. So are there, apart from this one instance which was there, any other pressing points that have been, say, more of a persistent issue? Any guidance on that front would be really helpful.
So management transition, it's very early days as yet. You would appreciate that we announced the management transition in December. So it's very, very early, is the point I would make. So it's a patience play for us as a management team, and clearly we would request you all to be patient as well. And only thing I would say is that it's being done in a highly disciplined, rigorous, and a planned manner, and we're all working towards making it a successful transition. So that's first part. Second part, clearly in terms of regulated matters, our preference would be to not comment on it. We remain committed to compliance and form and spirit. Areas that we are identifying even on our own, we are acting on, in addition to annually points being raised by Reserve Bank. And are we all, given the actions on us, are we committed as a company to ensure that we don't create such a recurrence? At least as management, we are fully committed to. And, that's what I can say.
So fair enough. Thank you, and all the best.
Yeah, thank you.
Thank you.
Question.
Next question is from the line of Kunal Shah from Citi. Please go ahead.
Yeah. So firstly on credit cost again, so given that there is a pivot which is happening towards the secured business and maybe towards a relatively lower yielding portfolio as well. But in terms of the credit cost guidance, that still seems to be slightly on a higher side at 1.75 to 1.85. So maybe last time you indicated urban B2C as well, which was in the watch list, but it doesn't seem to be the case now. So then maybe could it be like, are there any other product segments which is becoming a cause of concern, or they are like the normal write-offs which we are seeing in the business, which is leading to this kind of a guidance? Yeah.
No, first thing you have to remember that while we repivot towards secured assets, if you look at the transition is 2.5%. So 2.5% of assets went down in terms of unsecured and went up, and correspondingly other portfolios went up. So it's a pivot that will happen gradually. It's not doing anything considering the secured businesses are low risk businesses and unsecured are high risk businesses is a myth. If both done poorly or will yield the same negative result. So it's a gradual transition. It is not a quick transition, but clearly the roadmap is to create a more granular portfolio. There's no question of balance. We've been running this mix for many years. We have published to the street that our LRS plan is to compound at 25-27%. So it's in that direction. There is and all shifts will be gradual in nature. So that's why even while the assets may come, as the mix moves, it all comes with a lag effect. So that's the only point, Kunal, that you have to keep in mind.
If I may add, Rajiv, I think in addition to that, Kunal, if you look at last year performance, right, we delivered 1.63 loan loss to average year. Adjusted for the macro and management overlay that we released in the last year, the number was 1.82. If you look at pre-COVID, adjusted for growth, of course, we used to grow reasonably at faster pace at that point in time. On a normalized basis, the loan loss to average AR pre-COVID was 1.65 to 1.75% kind of corridor. Rajiv will talk about some of the regulatory changes with respect to definition of NPA that happened last year. On top of it, as you would remember, we have made this point in couple of earnings call as well. We have significantly accelerated our write-off policies to ensure that we don't carry any residual risk in the balance sheet. That has also led to 10-12 basis point impact on the overall loan loss to average as a metric. If you take both the things together, I think 175 to 185 is a normal corridor, in addition to what Rajiv has communicated.
And mind you, Kunal, 4 years later, the balance sheet is 3,30,000 crore, 1 lakh versus 1,40,000 crore. But we've ensured that the credit has remained. In fact, if you knock off the points Sandeep is making, we are lower than where we were versus FY20. So balance sheet is up 2.8x and 2.8x, and credit costs have held flat, rather marginally reduced if you knock off these regulatory changes that came in. However, to your last point, as the mix pivots a little bit, sometime in 26-27 you will see an impact. It will not even be this year and the next year.
You mean 25?
I mean 25-26. You may see some impact. You will see full impact only in 26-27. In terms of if the of the slow or gradual pivot that we are walking towards.
Sure. So, on an average, what could be the write-offs, maybe, if we have to look at it, maybe currently, maybe this quarter also it seems to be on the higher side, but, what should be the average write-offs given the profile of the assets which we are building? So just wanted to gauge that, because today, in terms of the, GNPAs as well as net NPAs, those are like, as you mentioned, historically low levels, yeah.
So I think if you look at, Kunal, by that logic, I think the overall provisioning versus last year to this year is very well disclosed. The differential is nothing but the write-off number. I think barring 10 basis point which goes towards provisioning, balances towards write-off only. Eventually,
and that might not improve. Yeah.
Eventually, what you do is you settle the account with the customer by taking a charge off after consuming all the remedial or measure that is available for you to do debt management services.
Sure. And one last question in terms of the BHFL. So again, if I look at in terms of the NIM trajectory out there, given that that's also like more than 25% of the AUM, it seems like NIMs there itself have contracted, and that has led to like almost 21 bips kind of a contraction on a quarter-on-quarter basis. So overall profitability was also low in BHFL compared to Q3. Year-on-year, it sustained. But how should we look at the BHFL, both in terms of the margin as well as the ROA profile? Does it improve towards 2.3, 2.4, or like 2% seems to be?
I mean, so 2 points. Clearly, that if I may use the word in a lighter vein, the madness in terms of competitive activity in the mortgage space. Borrowing cost for BHFL in NCD market is at 8.3%, and home loans are being distributed at 8.4 and 8.5%. So we are in that zone that it's a pretty crazy zone. So that's point number 1 for me to make. Point number 2, clearly our guidance on a long range basis, while the company has delivered a 15% ROE in the current year, we believe that anywhere between 13 to 15% ROE on a sustainable basis is really where the business is anchored on. So that's the way you should look at the business. It is that a range bound 13, 14, 15% ROE on a sustainable basis amongst the cleanest, largest businesses in India, which are focused on and a great annuity business that we are headed to create. Is how you should look at the business. Amongst the largest, amongst the lowest risk businesses, 13 to 15% ROE, and compounding annually between 25-27% to create a great annuity business. Its cost to income ratios should keep going down, so making it more and more competitive as it becomes larger in size.
Sure. Okay. Yeah, thanks and all the best. Yeah.
Thank you.
Thank you. Next question is from the line of Concall from Oak Lane Capital. Please go ahead.
Hi. Thanks for taking my call. My question is, just wanted to correct that there's 70 bits increase in the cost of fund, right? In spite of the ECB cost borrowing up. The ECB is a percentage.
On a full year basis, Concall?
Yeah, in
a full year, yes.
Yeah.
If you go to the panel, I think there will be.
That's correct, Concall.
Yeah.
It's 70 basis point over last year. That's correct.
And there is a 4% impact on the embargo on the PBT level.
That's correct.
In the current quarter, yes.
Okay. Thanks for this clarification. Rajiv, the question is, you mentioned in passing about account aggregator, ONDC, rewards, and various planning in the products you are rolling out. Can you just throw a granular light on how does it impact franchisee profitability and so on and so forth?
I mean, account aggregator we think is a fundamental shift in the way business will be done. That's really how we are driving the business at this point in time. As I shared that it's 8.1 million consents. I mean, based on the consent of the client to get his, in a structured manner, his entire bank statement, allowing us to underwrite him right, price him right, expand exposures, portfolio monitoring, early warning. It's a dramatic shift, let me tell you. And the company has been driving that since November, and that's how, as I mentioned, we are 22% of India's consents at this point in time on a daily or a month-on-month basis. This data is published on the Sehmati website. So clearly, we are very excited. It dramatically opens up clearly new growth path for us as a company or for any company that intends to use it. Because so that's one. Two, ONDC, while it has no commercial outcomes, but clearly would dramatically improve engagement rates for our 52 million customer franchise. We're adding 3 to 4 million customers net installs a quarter. Jan 23, 1,000 orders a month were happening. 8.2 million orders happened in January 24. A year later, from 1,000, something went to 8.2 million. That's the kind of growth rate that ONDC is principally experiencing, clearly customers are ready for it. So that would improve dramatically the engagement rate, our opportunity to engage with the customer. So that's the second part. Social commerce, clearly, as I've said, people are spending more and more time on videos and photos rather than content. Our app infrastructure, our web infrastructure are more organized to content. Social commerce clearly is nascent, but the way we are engaging on a day-to-day basis are more and more social. So that's going live. It'll have real infrastructure and so on and so forth by June, July. Rewards is an open architecture customer acquisition engine that is built on back of a PPI platform with host of benefits. It's a paid program that if customer wishes to buy, should help us acquire more new to Bajaj customers and engage them over time to take all financial services products. So these are big bets, Kuntal, that we are making from a medium-term standpoint, some short-term, some medium-term, and could dramatically alter the way the business looks in the medium term.
Are you throwing in the expense management and all the related tools for rewards for enterprises, or it's just...
So expense management as it is there even today in the asset, but we don't find too many, the utilization rates to be very high. So what happens, Kuntal, is if you get all the bank statements, then expense manager using account aggregator is relevant. Our intent is to underwrite and lend to a client. Making him give 5 bank statements is in my mind, personal assessment, practically not feasible, because at store or at wherever the client is, one main bank account mostly tells the story. So if you want to deliver a full-fledged expense manager, then you need to get all his bank accounts, which is not practically feasible as I said.
This is my last question. We had a 2% degrowth in AMI franchisee because of the embargo.
Yes.
What is the time frame you are expecting for RBI to revert, and when would you be able to fire that engine?
I cannot comment, Kuntal. As I've said, we have completed the compliance and we are awaiting next steps from RBI.
Thanks for taking my call. All the best.
Thank you. Next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, hi. Congratulations to the team on the quarter. Just 2 questions. One is the FY25 guidance that we have given on various metrics. I mean, does that factor in the relaxation from the RBI on e-com and Insta-EMI cards, or you are assuming that it will, I mean, the guidance is assuming that the situation that we are in today, that kind of continues?
Yeah, sometime in near future, we assume.
That the relaxations will be lifted, right?
Yes.
Okay. And the second question is mainly pertaining to the listing of the housing finance entity and Fast 281. The shift that we are seeing between secured and unsecured at this point of time, is it just temporary given that some businesses of ours are under embargo, or it is more structural in nature that DFL standalone will start building more secured businesses on its own? And the second part of the question is that the long range guidance that we have given in the presentation, it's predominantly console. Does the listing impact that in any way? Yeah.
So look, structurally, let's step back for a moment. Our market share across lines of businesses remain very low. We've come a long way in 17 years, but when you look at our market share across lines of businesses, in personal loan, our market share is 7%. Okay, it's been at 7. It was at 7% in 1920, which was pre-COVID. Since then, all the action happened. Even today, it's at 7%. 7% of all disbursements in India, plus minus, this is bureau data, is a market share. So structurally, we are not talking a structural movement. We're just saying that at a design level, there are opportunities in lines of businesses given the growing franchise like auto loans, like LAP, because BHFL by design has to principally focus on home loan, because 60% of the business has to be home loan, and 15% has to be developer finance. That is 75. They've built a phenomenal business of CRE, that's 10-12%, so that leaves only 7-8%. So there's very little scope for them to do LAP, so that's how LAP came in. So we're looking at opportunity rather than changing the mix at a structural level of the business. Umang, it's important I clarify that. Of course, you have to take into account external environment. You have to take into account various optics to ensure you play year at a time. But no change in structural guidance for us as a company.
Okay, and the long range guidance on a Concall entity basis, that also kind of remains.
Yeah. So, okay. It's a good question. I am sorry to not have responded. Clearly, some point in time, based on the committee's decision, but anyway, the committee's decision is contingent between now and September 25. By September 25, we have to list the firm based on the upper layer guidance. We are encouraging both companies should principally be more Atmanirbhar, look at their rightful mix. BHFL should focus on ROE and BFL should focus on the balance between secured and unsecured. So from a directional standpoint, as BHFL gets listed, the Concall conversation is as important as the standalone conversation for each one of the entities from a long-term standpoint. And which is what we are driving them for. So in a way, to the point that you're making, that's why also launching some of the lines of businesses in BFL to make sure that when we start to look at them independently versus consolidated, they should be a lot more self-sufficient in terms of all metrics which are relevant for the business.
And sorry, just one last follow-up. So, does that mean that at some point in future, post-listing, can Bajaj Finance and Bajaj Housing Finance compete in the same product line?
No. We would never do home loans. BFL would never do home loans. If it ever did, it may do it on an assignment basis for BHFL. LAP, both will do. Market is very large. BFL is very large in MSME. As a business line, it's a core need or a product requirement of MSMEs. As we grow our relationship with those clients, LAP is a needed product, and I articulated earlier to you. So we may end up competing on and off on a client basis, but not on a structural basis. BFL would never do CRE. BFL would never do developer finance. It's not its business.
Okay. Thank you so much for patiently answering my question. Thanks and good luck.
Thank you.
Thank you. Next question is from the line of Piran Engineer from CLSA India. Please go ahead.
Yeah, hi team. Congrats on the quarter. Just a couple of questions. One, a follow-up on Umang's question, and you mentioned Atmanirbhar. Just wanted to understand, once the two entities are actually Atmanirbhar, how will the customer data sharing work? In the sense that one of our propositions was you acquire and cross-sell.
Even today, it's on complete arm's length basis. It's on arm's length basis.
Okay,
if we originate on their behalf, we would get paid a fee for it because we are mining our franchise. So,
okay, and is it fair to say bulk of their customers are your customers, or do they have a large share of independent fees?
35%.
So to answer this, end of the day, eventually 35% of our customers end up to be BFL customers, but some of them on account of just BFL customer franchise being that large, not account of being originated from the leads which come through BFL franchise. But yes, end of the day, 35% of the customer base would be common between BFL and BHFL. BHFL customer being a BFL customer as well.
Got it. So you are independently sourcing 65% of your customers.
So our digital mobilization on BHFL website and BHFL assets is completely independent or through the web SEO activities, what we do on our own, where we get the customers. Along with that, BFL does mobilization of its customer base through digital channels and its app and web platforms. Any customer which consents to take a loan, which is a mortgage loan, which is being serviced by Bajaj Housing Finance, the consented lead comes to BHFL and the revenue sharing happens on that at a lead. Conversion happens in the BHFL side, but there is on the lead sharing basis, arm's length basis, the revenue sharing happens. Yes.
Understood. Okay, fair enough. Secondly, I just wanted a few clarifications. Firstly, when I calculate your ROA, just a simple calculated number is around 4.5, and you all for the full year, you all have reported 5 or 5.1. So do you all calculate it on a denominator of loans or something like that?
Yeah, we calculate it on loans only.
Always.
Unlike bank where investment constitute a significant portion of the balance sheet and is part of the deposit gathering process, for us the interest earning asset is only loan, lending that we do.
Okay. So simply put, you're expecting a 30-40 bip decline in return on loans next year.
That's correct. On a portfolio basis, answer is yes.
Okay, fair enough. And just secondly, I know this has been discussed before, but why exactly?
On a year-on-year basis, Piran.
Yeah, year-on-year. Yeah. And why exactly are credit costs going to be elevated in FY25 also, given that we've curtailed our disbursements in rural so much, even in urban to an extent? Just wanted to get a sense of that.
Sorry, Piran, I'm sorry. Could you just repeat your question? Yeah. I lost you in between.
Why are our credit costs going to be 1.8, 1.85% next year also, given the initiatives that we've taken this year in terms of curtailment and improving our underwriting?
So it's a fair question. Some of the portfolios have continue to see ever low. I'll give an example that the two-wheeler and three-wheeler business has just started to come in terms of pre-COVID normalization only since December. So clearly we expect rural B2C will normalize, but we are seeing that there are still, actually that's the only portfolio left, which is yet to come back to pre-COVID levels. So that's really what we are taking into account as we assess how FY25 would look like. So that's the only residual portfolio that principally as yet is not back to pre-COVID levels.
Understood. And just lastly, we had increased our lending yields by 25-30 bits last quarter, in fourth quarter. But yet we are talking about a 30-40 bip margin compression. So the cost of funds impact is so severe, is it?
But
can we not increase yields more?
No, we had increased, but the net flow through that we're seeing based on intense competitive activity is only 12, 14 basis points. I mean, clearly, as I said earlier, in terms of home loan rates are still at 8.4, 8.5%. I mean, as Atul is saying, it's 8.5 to 8.6, but our borrowing rates is at 8.3%. So clearly the intensity of competition continues to be really strong. So net flow through has been 12, 13, 14 basis points depending on the month that we're talking about. Yeah. And cost of funds have inched up by 10 basis points in the quarter that went by.
Yeah. And let me just, for the sake of repetition, let me repeat what Rajiv commented at the beginning of the call. I think one, we see some movement in cost of fund and we forecast a peaking probably by August. At the same time, there is a pivot towards secured asset mix in the balance sheet. That also will have some impact on NIM. I think these are the two important points that I thought I should reiterate.
Okay, fair enough. Thank you and wish you all the best.
Thank you. Next question is from the line of Dhaval from DSP Mutual Fund. Please go ahead.
Yeah, thanks for the opportunity. I just had a couple of questions. First is on just trying to reconcile the expectation for next year from an earnings perspective. So we roughly expect about 7-8% kind of ROA decline from 5.1 going to, let's say, midpoint of the guidance about 4.7. That translates about 7-8% kind of decline on profitability. At the same time, if you think about asset growth, that's going to be about 26 to 28 based on our expectation. If you take the midpoint, net, we are looking at 20% profit growth for next year. versus our medium-term aspiration of 23 to 24%. So the question is, should we expect some bit of catch-up into FY26 based on your rate expectation and your expectation of RBI embargo being lifted? Will there be some normalization of profitability in FY26 to get back to our medium-term expectation of 23-24%? So that's the first question.
Yeah. So then I think your assessment is correct to a large extent. 26 to 28% is where we see the growth in the next year to be. That's one point. Second, as Rajiv articulated, 30 to 40 basis point movement in NIM could happen in the next year. We expect the loan losses to be range bound. It does give you an indication about where the profitability could be. So I'm not commenting on a specific number, but probably that's probably an indication that you are highlighting. Going to FY26, as Rajiv was highlighting that in the last 4 years, we had 2 years of low and 2 years of high. It is against the high year that we're comparing YY growth. As we get into FY26, assuming the macro continues to remain healthy, regulatory environments remain conducive, I think your point again remains valid. We should go back to our medium-term guidance of 23-24% kind of profit growth.
Hello.
So the line for the participant dropped. We'll move to the next participant. The next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, hi. A few questions. The first one, the way you are highlighting the challenges in the rural B2C, and if you look at some of your new segments, maybe gold, of course, you separated, MFI and of certain segment, used vehicle, they are kind of a bit linked or similar in nature to the rural B2C. So in this backdrop, on one hand, you are going slow on rural B2C. So how do you see these segments to sort of come over the next couple of years? So that's question one. And second would be more into do with BHFL, of course, coming from a smaller base. You are ramping up very fast also on the LRD and developer finance. Now, developer finance is a bit, reasonably cyclical business, and the cycle turns quite fast right now. Of course, real estate cycle looks quite good. So, what sort of any sort of growth plan you have, particularly for this developer financing side, and as well as what kind of early warning system you would have in place to address this? Okay, thanks.
Both are two different questions, and Sandeep can answer the first one. In terms of the mix. Look, structurally, I would want to reiterate that the mix will shift gradually, number one. Two, our market share across lines of business remains small. There's tremendous opportunity in every line of business. We have grown even the consumer durable business. Our market share has grown on a year-on-year basis. Where we are in high, if I take the bureau data, we have a 51-52% market share of consumer durable loans being booked. We have gained share. So, as I said, personal loan, we are only 7%. Rural B2C is a transient conversation. We are waiting for GFRs or gross flow rates, which are early indicators of the health of the business, to go back to pre-COVID levels. As it goes back, we'll be back to growth. Because the franchise on a year-on-year basis, if rural B2B is growing by 34, the least that should happen is rural B2C should grow 34. On a very simplistic basis. Whereas rural B2C grew only 6%. So there's a significant amount of dry powder that is available with us for us to be able to accelerate. But we never accelerate a business if we are not in control of the risk matrix. We are seeing GFR rates go down over the last 2 quarters. I think it will be one more quarter, and by second quarter, as it goes back to pre-COVID levels, we should be back to growth. So that's the first part of the conversation. We want to make sure there is no confusion that are we changing direction in terms of our mix. We are changing direction in terms of mix, but in a very gradual manner. I want to reinforce and reiterate that point. Point number 2, I'll let Atul respond to the developer finance. I'll make only one point, that it's a business that we've done for the last 7-8 years with a eye on risk rather than eye on profit. Rest I'll let Atul respond.
If you look at a developer finance book, while it is looking like in AUM growth, it is grown exceptionally well in last 1 year, but at the absolute size of the balance sheet still remains sub 9,000 crore, which is a very minuscule portion of the market size what it is there. Because we had been building a granular book over the year. When you look at an average ticket size and an average outstanding, because this book represents close to 440 relationship and close to active 600 projects. So it's very granular in nature. It is being done for two parts. One, of course, as a return enhancer for a mortgage business, because as you are all aware, in the prime home loan market where we, as BHF, we are more operative, the margins are razor thin because of intense competitive activity. Developer finance is required in a calibrated manner to deliver a return enhancement and also to ensure that we build our home loan presence at the developer counters, because that is a core home loan business. So it is not only a return enhancer, but it is a core to the company's strategy. In the medium term, we had guided that the business will remain in range bound, not exceeding 12 to 15% of the balance sheet mix. And as we grow forward, that is how we like to look at the business. Continue to grow in a granular manner, continue to use it as a bit of a return enhancer, and also more important as a strategic block to get us heft in the home loan business.
And in the LRD, how do you see a competitive environment? Because in LRD, even banks are reasonably active.
LRD, we have, I'll say that's one business we have done exceptionally well besides developer finance. We built a name in terms of our size is quite relevant. We compete with the banks. We compete with the banks for the marquee customers. Our customers are the real market along with all sponsors funds and the REITs which we cater to. We are intensely competitive in that segment. That is because the OPEX ratios are very small there. The returns are in line with what a mortgage return happen, and we will continue to be aggressive in LRD space to deliver the third part of the mix from a home loan plus developer finance, which is our regulated business, because it is as a housing finance company, we have to maintain a 60% home loan asset base. The remaining part will be focused much more on LRD to have the 100% mix.
Just to add one more point on the B2C piece, I think just to reiterate what we have always communicated, I think we run a diversified financial services business, and the power of the diversified model is that it allows you to take rightful call when you see a particular business not doing well to your expectation. In that context, we believe at this point in time, we are better off keeping our rural B2C at a little bit of slower pace. Once we see portfolio mix to start, portfolio quality to start show improvement, we'll be more than happy to bring back growth in the business. I think that's just a point of reiteration that I want to make.
Okay, thank you.
Thank you very much. Ladies and gentlemen, we'll take that as the last question. I will now hand the conference over to Anuj Singla for closing comments.
Yep, thank you, Nirav. Rajiv sir, any closing comments before we conclude?
No, thank you all. Thank you all. We look forward to your continued support in FY25 as you play along and build a business for the long term. Thank you. Thank you so much. Good night.
Thank you very much. We conclude this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.